there we are. There we are, Anthony Smith. Welcome to Freightonomics, the remote edition part two, where we discuss the combination of the macroeconomic environment, combine it with the transportation sector. Anthony Smith, lead economist, over there in his kitchen. Zach Strickland here in my bonus room with headphones this week. So I'm headphones zacked up this week, Anthony, because I thought it made me look more like an official podcaster. And you've got like
I
an
have
official mic.
headphones here, but I don't use them. And I'm not sure if my mic's actually connected, so I'm going to need some tutorials. But this is my kitchen, but it's a studio, so it's also kind of like off of my living room and bedroom at the same time. It's efficient. What more would you expect from an economist but efficiency?
Exactly. I like that. That's where we agree. We totally agree on efficiency. So it's a big day today. We
It
had
is.
the inauguration that went smoothly, thank goodness. And there's a lot of activity surrounding that. We'll dive into that here in the stories of the day here in a minute. But we're going to have Dr. Zac Rogers on this week to kind of give us an update on that LMI action, as well as talk about the ongoing problem with all these bottlenecks. I think the story of 2021 is going to be how do we recover from 2020, and a lot of situations that started in 2020 still have yet to be resolved. And again, the newly inaugurated president, is going to have a lot to do with that in the long run, maybe not so much in the near term. If you paid attention to our show with Will Sested talking about regulations back in December, most of the impacts of a presidency don't really start until later in the year, once they're inaugurated and out in office for a little while to give them a little bit of time. There's a freeze period put on a lot of their actions for the first few days, but doesn't mean that they're totally ineffective. They just have to. It just takes a little while to get through the bureaucratic processes. That being said, Anthony Smith, are you watching LinkedIn today?
I am. I have LinkedIn pulled up here, and we already have James Fry saying, "Good afternoon, gentlemen." Special shout out to James Fry. We have Laura Graves in here. Hello. So yeah, I'm watching LinkedIn, monitoring it throughout the show. So if you want to jump in on the conversation, have any questions for Zach, myself, or Dr. Rogers, who will be joining us shortly, let us know.
Absolutely. So let's dive right into some of these stories of the day. Of course, the biggest story of the day is the inauguration of the president. And an article that I've targeted here on FreightWaves.com, written by the illustrious John Gallagher, is can Joe Biden get infrastructure done in 2021? I think I already answered that a little bit by saying probably not. But that doesn't mean that in the long run, he will not make some headway into getting some of the consistent infrastructure, backlog of projects funded and underway. Something that I don't really want to get political about any of this, obviously, but one of the things I do believe the government has a responsibility for is providing adequate infrastructure. That's your roads, utility structures, things like that that really make a society function efficiently and effectively. It doesn't mean that they need to get involved with a lot of regulations or anything like that, but it does mean that they do need to provide adequate funding to keep these things operational. I mean, over time, things degrade. Our roads obviously need consistent maintenance, the electricity, water, airports, and of course, some of our intercoastal waterways and things like that in our ports need a little bit of help from time to time. And there is a massive, I encourage everyone that, is not necessarily familiar with infrastructure and, what kind of projects this is to check out this article on freightwaves.com. But one of the most interesting aspects of this whole thing, if you don't want to read, go down to a chart. Charts are always great to, really summarize what's going on with what the article is trying to say. And surface transportation needs, Anthony Smith, how much do you think, how much money do you think that they need to fund to get our infrastructure back up to just basic standards?
To get them back up to basic standards,
Just
I guess it'd be
basic.
somewhere in the trillions for sure.
Yeah, yeah, 2.5 to be
Yeah.
honest. So we have half of that funded at 1.3.
Mhm.
So it is a significant, just half of it is being funded right now. And that's not that's just to get it up to par, not to get it, into the future and ready to go. So there's significant amount of spending and funding that needs to go on there to get things back going, and that obviously has a huge impact on transportation and things like that.
It does. And the sad thing, a lot of the times when it comes to infrastructure, it's not that entertaining for people to hear. A lot of times you hear about infrastructure, people are like, oh, this is boring. I don't care, but it makes a big difference. And if you see tax dollars going towards infrastructure, a lot of times people aren't that thrilled about it. But it's one of those things that you just need, and it helps with efficiencies. And this is one of the things we have our monthly Sonar podcast that we go over a lot of the macro trends and transportation trends. And this is one of the areas that I was a little bit more optimistic about when we look at non-residential construction through the latter half of the year, when we're looking at infrastructure spending and construction costs, highway, roads, things like that, just because we're not going to see a lot of construction activity for offices, things like that. Not a lot coming from recreational construction for sure, but there's likely going to be some opportunities for state and local construction jobs and infrastructure, things like that. But that's all going to be really, really, I think, like you said, it's going to take some time. It's not going to be immediate, but it's going to be a potential area of opportunity as we get to the middle half of 2021 to the latter half of the year.
Yeah, and I need to make a correction. It's 2.5 billion, not trillion, from what the article states. I misread that. So yeah, I mean that's better. So, um, that being said, there's still a long way to go with that and how that's working. But we did have a few earnings reports come out as well, Anthony. And I didn't put this in the notes, but I think we're going to talk about this more in a later episode after we get a few more in. But I think it is interesting to make a point that some of these carriers, JB Hunt, Heartland, have now come out with some earnings, and there's a little bit of mixed signals in there right now. It's not just like they blew apart everything, and we'll break those down probably in a future show. But I think this earnings season is definitely going to be interesting because a lot of people think, including myself, that if you were an asset-based truckload carrier, you should have had a pretty solid fourth quarter. And Heartland actually pulled back revenue while increasing operational margin. So they were able to operate more efficiently with less money. So that to me is a little interesting. I'm going to do a little bit deeper dive into that because the fourth quarter massive for a lot of carriers and a lot of shippers out there. And speaking of that fourth quarter, the next story of the day that I think was the most interesting was the one written by none other than Andrew Cox. Not necessarily a formal contributor to FreightWaves.com in terms of article generation and things like that. He's not necessarily a journalist in that regard, but neither am I. And I tend to, I'll throw up a posting every week as I do with the chart of the week, but he breaks down the retail segment in the fourth quarter, and he says, despite losing momentum late, holiday sales surprised to the upside. So, just to summarize this article and what he's talking about, he is spearheading this new product offering from FreightWaves called Point of Sale, and it involves all sorts of subscriptions and newsletters. He's starting up a podcast to really target sectors more specifically, and this is one of those. This is a sample offering, if you will, and it basically outlines how the holiday spending actually kind of came back off of November's levels, but it was still a record December overall. And I think that's a very solid way that he positioned that. It's not necessarily, oh, retail sales, contracted in December. Yeah, they contracted off of a record November, and there's still a record level of December activity going on. And this is one of those things that's going to consistently, it's going to fuel what we have left to go in this first half of 2021 in terms of overall restocking events and freight movements.
That's right. And this is another one of those topics that we touched on. I think, geez, I mean, that report came out last Thursday, I believe, for retail sales. And so definitely was a brief talking point for me on the midday market update, and glad to see Andrew go into more depth on this. And I think we went onto it again on that monthly webinar we did yesterday. But yeah, we saw a decline for retail sales. I think it was down 0.7% from November to December. We've been talking through Freightonomics about some deceleration within retail sales. So not too much of a surprise that we saw this number come out. I think the biggest surprise was coming from that non-store retail subsector. which has been a strong segment throughout much of 2020. We saw that come down 5.8 percentage points. But again, it was still up 24.3% on a year-over-year basis. So we are definitely seeing some slowing, some easing on a month-to-month basis, but on a year-over-year basis, still extremely robust, still near record levels at any measure for a lot of different segments when we're looking across the board at different breakouts. So still a lot of growth, like you said, a lot of activity still going on, but there is some deceleration there. But there are a couple of bright spots potentially throughout 2021 that is slowly building momentum. All this is somewhat losing steam on a month-to-month basis from record highs.
Yeah, and I think him and Seth actually addressed some of the, the momentum that's going to carry into the first half of the year on Container Mageddon on their Great Quarter Guy podcast yesterday too. So I love the title of the
Yeah.
podcast. I haven't listened to it yet, but Container Mageddon, quite aptly named for this time of year, especially right before Chinese New Year. So, I think this is a good point to start segueing into our guest, Dr. Zac Rogers. The illustrious Zac Rogers from Colorado State, big contributor to the LMI.
Yes.
He's been growing his hair out, making sure that he gets his best quarantine life going. But here he is back again. Dr. Zac Rogers, welcome to the show.
It's good
How
to
you been?
see you guys. It's the
Yeah.
only way I can keep track of how long the quarantine's been going is how much the worse I look, the longer it's been, essentially, is the metric I use. Also, it's nice to talk to you guys from your house. I've been calling you guys from my home office this whole time, so I finally feel like we're on equal footing here. I'm a little less self-conscious about like having stuff behind me now that everybody
Right.
does.
Yeah, I got an entire stove.
Yeah, no,
Yeah.
it looks bad. Whatever you're doing.
So
But
Dr.
Zac
Rogers, so
thank you so much.
we've got the LMI came out in December. We saw a little bit of this. I don't want to call it easing. I think everybody starts to think, oh, you mentioned one sign of a slowdown, and everybody's like, it's over, it's over, and that's just not accurate. We're still extremely tight on the transportation capacity side. Warehousing capacity still difficult to come by, but some of these numbers eased a little bit in December, correct?
A little bit, yeah. And again, I would remind everybody it's all rates of growth. So any number that we get above 50 means growth. Any number below means contraction. And the further below or above, the greater the growth or contraction is. So the LMI was still a 66.7 in December. So that's still a very solid rate of growth, well above the average of the 4 years we've been doing this, but a little bit below. It had been in the 70s for the 3 months before that. So the rate of growth is down a little bit, but it's still growing. If we were kind of going like this, now we're just going a little bit like this, but it's still going up. And a lot of that, though, I think I should point out, is driven by a decrease in inventory levels, which we always see a decrease in inventory levels in December because that's when a lot of retail sales happen. Now, I will point out, inventory still went up slightly. I mean, very mildly. It was a 56 in December. But if you compare that to December 2019, it was only a 42 then. Okay, so we had inventory levels actually went down last December. And remember, kind of there was a slowdown with the industrial sector and everything. But this year, we're at a 56, 57. And so, yes, we're slowing down, but we're not slowing down the same way we normally would. And I think that's a lot because of, and it relates to Container Mageddon, which I also like a lot. We have all this backlogged inventory coming in, right? So all these, I mean, there was 20 ships sitting outside the port of LA last month, just waiting every day, basically, to get in.
Right.
And so we have this sort of backlog of inventory that's slowly trickling in, and it's going to take us a while to catch up.
Exactly. And so I was talking with Greg Miller this morning and Henry Byers. They're both very much maritime experts. And we've seen some kind of this early warning signal in some of our data about bookings and bookings behavior. And it's very difficult to get a clear picture of what's happening here, but it's starting to show signs that like shippers are not booking as much freight coming into the country. Now, Chinese New Year timing and things like that make it hard to see year over year trends and stuff like that around this period. But do you think that some of this may be simple frustration on the shippers end because they are so backlogged? They can't get the freight coming into the country in a timely manner. That 14 to 21 day lead time is now like 6 weeks?
I think so. I think it's, around here in Colorado, if you're going to go skiing on the weekend, you either got to go at 6 a.m. or wait until like 1 o'clock. Because if you go at 9 or 10, you're going to wait in line on the highway for 3 hours before you get to the mountain. And I think that's what's happening here. There's kind of no point in booking it. Plus, you consider the price piece of it. Last month, I mean, container prices are up like 174% or something year over year, like some crazy number like that. And so if it's something that we can get in later and it's going to take forever to get there anyway, and we're going to get it cheaper, I do think that's part of what we're seeing. I don't necessarily know that it's a slowdown for anything other than just, I mean, if price is up 170%, demand is going to go down. I mean, I think that makes
Right.
sense.
Yeah, and the fact that they can't get a container anyway, because
Right.
there are container shortages all over the place.
Yeah.
Yeah.
I mean, I think the headline
So
should be like, companies decide not to pay more for worse service. Like, oh, okay. Yeah, sure.
makes too much sense. Yeah.
Right.
So, some of the slowdown, obviously, it might be cannibalizing itself a little bit in terms of, I think I even mentioned it in my article this week about how the level of, transportation pricing being where it is and the low availability of service, it just can't sustain at this level. Otherwise, companies will run out of cash and the ability to invest. So there has to be some sort of like correction period where we go through and normalize the flow of goods, right?
I think that makes sense. I mean, there's some goods that I don't know that we can slow down the flow. And those companies might be in a tough spot. If we look at transportation prices in the LMI, just over, and especially price and capacity together over the course of 2020. So in January 2020, we have transportation price at 50. So meaning no movement, and things were kind of dead. Remember, there was a lot of 3PLs and fleets that were being shut down or reduced or whatever was happening. Capacity was at 57. So we actually had more capacity coming online, and that was partly because demand was low. So January 2020, capacity 7 points higher than price on our matrix. Let's go forward to December. Transportation capacity is at 39, which is pretty steep levels of contraction, meaning that it's harder and harder to find a truck. And prices are in 85. Okay, so we've gone from capacity being 7 points higher. Let me get in my camera. Capacity being 7 points higher than transportation to like a 45-point swing in the other direction. Okay,
Right.
And so prices are up so high, and it's because, let's take e-commerce. It was supposed to go up 15%, went up 45%. So we had 3 years of growth, 3 to 5 years of growth probably in 10 months. And so the infrastructure is just not there. I mean, you guys are talking about the infrastructure of roads and things like that. We also have a huge deficit in the infrastructure of trucks, warehouses, and just basic distribution capital. And I mean, we went forward 3 years in less than a year, and it's going to take us time to catch up. When we ask respondents about, hey, okay, in the future, what do you see happening? It's interesting. They predict more transportation capacity coming online in the next year. It's a 62. I think for the next 12 months. So some capacity coming online, but warehouses are a 50. Like basically it's like we're going to keep building warehouses and it's going to keep not making a difference because we're so short on all the storage we need. And so they expect prices to remain high. I think the predictions were like an 81 for warehousing prices and a 79 for transportation prices over the next year. So they're not expecting a lot of relief, and it's because of the lack of the capital to make it happen. Capital like equipment, not capital. Yeah.
Right.
So that talks to some of the comps that we're seeing right now on LinkedIn. We have James Fry saying, do you see it slowing down even more, or are we going to have another spike? And so from those comps, it sounds like we are expecting some considerable tightened capacity, even though there might be some quote unquote easing throughout.
I think so too. I think we're going to bring on fleets as quickly as we can, but it's going to be hard to keep up, especially now, the new administration and the new Congress, which is also happening today. The stimulus is going to be significantly greater. Last time when I was here in December, we were like, well, we don't know, and it looks like now, because of the way the elections went, instead of everyone gets $600, they get 2,000 maybe. And there's going to be a big investment that they're going to talk about probably at the State of the Union next month in infrastructure. And so I wouldn't be surprised to see the consumer stay strong. a little bit. Zach, I think you actually wrote the article because I am a regular FreightWaves reader about the consumer drove a lot of the tightness last year,
Mhm. Oh
and
yeah.
I think we're going to continue to see some of that happening. So I wouldn't be surprised, Anthony, to answer your question, if we do see demand stay relatively high. And I think companies think that too. We lost 140,000 jobs in December, but we gained 53,000 in supply chain and logistics. So, I mean, clearly companies are building up. And December is not usually a time where you actually see a lot. Most of the people come on in November. So we saw these logistics companies bulking up at the time when everybody else is going down. I think we're going to see the demand for especially home delivery, transportation, all that stuff. I think it's going to stay high for a while.
Yeah, I couldn't agree more.
Yeah, and talking to that point with additional stimulus coming in, that $2,000, that's going to definitely be something a little bit more substantial. I think we saw a small blip for those that received a smaller stimulus. So only can imagine that that additional stimulus will impact some consumer spending trends. I think the other big thing is the continuation of certain programs, and I don't think that gets a lot of attention. But we see continued claims for those unemployed individuals getting put back in place or renewed or extended. And we were talking about the potential of a lot of people being forced out of their homes, but a lot of those protection programs being extended, I think, are going to be also a lot of things that take a lot of pressure off of a lot of consumers that have really kind of been split off from those that have been able to retain employment.
I think you're absolutely right. I saw they're going to extend the protections like on student loans too. So we're not going to have to pay student loans, I think, until September. Which I went to 22 years of school, so that sounds great to me. I'd like to wait for a little bit.
I
Yeah,
don't know why
right. So
everyone doesn't play college
I want to
football.
pose a question to both of you here. So, yeah, we're excited about these stimulus packages and more government spending. I think that's traditional with the Democratic wing of things. Does this have any cost in the long run, though, that you maybe see that might be a trade-off somewhere? Because I think we all have been in that economics class where they basically say you can't just print money and expect it to always be there, right?
Yeah, so there's a couple things. I mean, obviously there will be some regulations tied into some of this that I think some people might not love. Like I know the insurance on like trucks will probably increase a little bit, like the requirements. But in terms of printing money, right? So the argument is interest versus inflation, I guess. Right now, the interest rate essentially is negative. If you're taking a 10-year loan and the interest rate's 0.25% right now, that works out to the interest rate really being like -1%. So if we were ever going to do it, if we're ever going to make that, remember during the recession, like, oh, we should just make a $1 trillion coin or whatever. If we're ever going to do that, it should be now because the interest is essentially nothing.
And the other thing is when we have these stimulus packages that get put out, a lot of it's getting put back into the economy. There's velocity there, although may not be the type of spending that we would want to see in the kind of environment that we want to be in. But we are still seeing that consumer trends really kind of having that activity. I think it would be a lot different if we were still printing off a lot of that money and it was just sitting in a lot of people's pockets, which some are. And I think that's a wise decision for sure. Maintain as much cash as possible, especially during times of uncertainty. But we are still seeing a lot of consumer spending. And I think it's good for those that are still able to retain their employment. I think definitely we always talk about the tale of two consumers, so those that have been able to retain employment, spending, working remotely, and really kind of providing that upward momentum for this e-commerce boom. But those that are maybe a little bit more on a week-to-week, month-to-month plan, it's going to be a little bit more touch and go with their spending habits, although it does seem like they are spending as well.
Well, it's that K-shaped recovery. Anybody on the bottom part of the K, they're going to spend money if they have money, right? The people who haven't been affected, I mean, if you give money to someone who's a millionaire, they'll put it in their bank account. If you give someone, someone making $50,000 or unemployed, they're going to spend it on something. And so, that goes directly, it's like you're saying, it's going to go directly in and stimulate a little bit, which I think is why transportation prices will stay high to bring it all back. Because, people aren't going to stop getting stuff delivered to their houses, I don't think.
No, I think that's a large part of what we're going to see here in the next year is, we're in the COVID world for at least another 3 to 4 months, it looks like. It's the case count is extremely high, and the vaccine's going to take time to get through that. So, my question is really, is this durable goods demand going to persist at the same pace that it did last year? Because I mean, you have this transition period and everybody goes into their house and they start looking around. All of a sudden, I'm tired of doing home improvement projects. Does this have like a lag, a tail to it?
Yeah. I was tired of doing home improvement projects before COVID, actually. So good for you. No, I think that it can't keep going at the same rate. So, we went up, like take e-commerce, went up 40% last year. It can't go up 40% again. I mean, it physically cannot. There's no way we could do it unless there's a secret fleet of drones somewhere that we don't know about. It can't go up like that. So I think we'll go back maybe to our normal rate of growth, 10 to 15% possibly, but we're not going to lose that jump that we did last time, right? Like we did a big jump and now we're going to keep going up. I don't know if you guys remember stepwise from like, trigonometry or whatever, but that's kind of what happened. So we went way up last year and then it's going to slowly keep going up, I think, this year, but I don't see it. I don't see it going back down. At the same time, I don't see us jumping up another 40% because I don't know that that would be tenable.
Yeah. So I have one more question for you before we have to wrap things up. But there is a measure in the LMI that we haven't really discussed it very much, but it's probably one of the more interesting points, and that's the inventory costs aspect of it. And it shot up in October, November last year. At what point does it become, that it's just not, it doesn't make financial sense to keep inventory because the costs are so high? Does that have an impact into
Right.
some of this downstream effect of transportation?
It hasn't yet. So it's right now it's a 72. It was 73 in November and October, which is well above the average of, I think, 60 is the average for that one. So I think right now a lot of it is, well, I can either pay a lot to hold on to inventory, or I can have a lot of stockouts, and those are my two options basically. And so I think companies are choosing to pay.
Yeah, it definitely makes sense. And Zach, thanks so much. Dr. Rogers, I should say, thanks so much for joining us. I think we're getting the cue from our team that we're about to wrap up. So real quick, where can people find more about the LMI?
The-lmi.com. We post our reports every month. It's always the first Tuesday of every month they come out, and you can see our first reports up there as well, going all the way back 4.5 years. And I would just say to wrap this up, I'm glad that you guys are working from home. It does make me feel more like we're on the same footing. All I need now is one of the sweet blue FreightWaves zip ups. Craig Fuller, get at me. Let me know what I have to do. And I mean, I'll pay half. I mean, friends and family discount for one, no problem.
Well, they're on back order. They're stuck in a container off the port of Los Angeles right now. So, no, we definitely need to hook you up with some swag, Dr. Rogers. Thank you as always. Stay safe out there in Colorado. You've got plenty of face masks now that you don't probably have to go out and wear one.
Yeah, I don't even need to wear a mask. This just protects the virus. Can't get through this.
Nice. Well done. Well, have a safe and a wonderful week, Dr. Rogers. Thanks for joining us.
Thanks, guys. See you later.
Later. I always like to kind of wrap him up before the outro cuts him off, because we always have some of these great conversations, and then in the end, it's like, well, here comes the outro music in the middle of a great point that he was making.
Yeah, he's insightful, and the thing is, it's like he's a great analyst, instructor, economist. He's an expert or subject matter expert. Like, sometimes I wonder, is there anything that Dr. Zac Rogers doesn't know or can't do?
Well, he's got a great name for it, that's for sure. So, Anthony, I think the consensus is that this is going to be a pretty solid first half of 2021. We keep seeing the same kind of results, a little bit of easing, but everybody's kind of pushing forward, even as we see some of these supply chain bottlenecks. So I think we're still going to have a little bit of disruptions coming up that we can't see yet. What do you think?
I think employment is definitely going to be the biggest thing. Employment across the board. But after that headwind, I think there's going to be a lot of upside.
Well, no doubt. Well, thank you so much for watching, and everybody have a great week.